All right, so we're starting off with the first question. Watuga Company has an inventory write-down to record and is deciding whether to use the loss method or the cost of goods sold method. Compared to the cost of goods sold method, the loss will report. So essentially, what you're doing is moving it out of operation. So our basic income statement, you have revenue minus your cost of goods sold equals your gross profit or gross margin. And your cost of goods sold contains all the inventoryable costs. For the items that were sold. And so if you put it in cost of goods sold, it affects the gross profit. Whereas if you do it under the other method, you'll have here minus your gross profit less operating costs. And then you'll get something like operating profit. And then you would have your inventory loss. Now, this kind of implies that you don't have control over your inventory loss. So most of the time, you're going to have to use the cost of goods sold method, and you're going to have to put it in your cost of goods sold. So whether the amount's here or here, your net income is going to eventually be the same, but your gross profit will not be affected if you use the loss method. So you have a higher gross profit, but your net income will be the same. That's letter B. When the cost of goods sold method is used to reduce the cost of inventory to its net realizable value, there's a direct reduction in the selling price or selling price of the product that results in a loss being recorded on the income statement before the sale. So that's not correct. Even though we think we're going to be able to sell it for less, we don't know how much we're going to be able to sell it for. So you wouldn't report a loss. A loss is recorded directly in the inventory account by crediting inventory and debiting inventory loss, not under the cost of goods sold method. Only the portion of loss attributable to inventory sold during the period is reported in the financial statements. So again, not from the cost of goods sold. You could have, we talked about inventory errors, other stuff in there. You hope it's not. It all depends on materiality, but the answer is D. The net realizable figure for ending inventory is substituted for cost, and the loss increases cost of goods sold. Lower of cost or net realizable value must be used for companies who use which of the following inventory methodologies? And that answer is D, all of the above. The designated market value on this one is A, always the middle value of replacement cost, net realizable value, and net realizable value minus the profit margin. Now, these won't always be in that order, but it's the middle value there. When hedging a purchase commitment, the purchaser enters into a contract which agrees to sell in the future, and this is the same quantity of goods at a fixed price. So hedging is pretty complicated. Just know, essentially what the goal in hedging is to reduce your risk. And so if you are going to buy a commodity on a future contract, the price of that commodity is locked in for you. So some companies will enter in a purchase commitment to also sell those goods in the future. And it's a strange thing that works out, but it reduces that risk of it fluctuating up and down. So if they get a large fluctuation or a large loss, they're going to minimize that loss. complicated. We won't get into it in this class. But super interesting because it really is about making sure that what you're focused on is your operations and making profit from there, and everything else is kind of going to minimize that risk. You know what your product's going to cost now for the next year, but if that changes, you can reduce that big loss that you could potentially have if that cost was to go way down for those products. And as a result, you would be paying a lot more, but because you're buying and selling on those future contracts, you can end up just buying it at that regular price. Pretty short class today. We've only got 2 goals. Explain when to use the lower cost or net realizable value, and calculate the inventory base using lower of cost or net realizable value rule. All right. Use the lower of cost of net realizable value all the time, and you calculate it whichever one is lower. So it's pretty straightforward. We're done here. Have a nice day. Yeah? Okay. Melissa said she wanted to get out of here early. She's going drinking. I'm just teasing. Very important thing going on. Okay, so describe and apply the lower cost of net realizable value. So when future revenue producing ability of inventory drops below cost, the inventory should be written down in the period in which the inventory suffers the decline in value. So what does that mean? I'll go back to Apple, but it can apply to Samsung or any of these big companies that are selling a new electronic product every year. Now, I've seen commercials where you can get still a new in-box older iPhone. I think they're out with 15 now, and you could still get a 12. If you think about each year that goes on, every time they produce another one, the value of what you can sell the other one for goes down a little bit because they tend to be right around the $1,000 price point. And so next year's comes out at 1,000. Well, what am I going to sell my new one for, my old one for? Now I'm going to have to sell it for less. Now, if you are paying still what you paid for it, you might have paid $700 for it initially. Now you can only sell it for $500. So you have to adjust because your inventory value is now below what you paid for it. You can't make a profit on it. And that occurred in this past year. And because we want to do what with revenues and expenses? You're not supposed to answer. You had your mouth full. I'm getting from the rest of the class. What's one of the important accounting principles? So why do we want to record revenue and expense in this period when the loss occurred? What's the accounting principle that we're talking about here? Matching, right? Be brave. Be brave, man. Yeah. Be brave in here. I try to keep everything light so you can say an answer, but you want to match it. You want to match it. You want to match the revenues to the period that you earn them. You want to match the expenses to the period that you incurred them. So we want to use the matching principle, and that's why we go about this. Okay. What do we usually record inventory at? We usually record it at historical cost. This is abandoned. When the future utility of the asset no longer is as great as the historical cost. Now, this can be applied to other things as well. If you have equipment that suffers a large loss, if you have buildings that suffer a large loss, this can also be applied to that. But we're talking specifically about inventory here. And so you use lower of cost or net realizable value. Used to be called lower of cost or market. Essentially, they're very similar. Definition of net realizable value. Which I'll abbreviate as NRV, is the estimated selling price in the ordinary course of business less reasonably predicted or predictable, I'm sorry, costs of completion, selling costs, and transportation, if applicable. Transportation is normally part of selling costs, but I think why they wanted to separate it out here is just to say, keep in mind that you have to count that part of it as well. Good. If I didn't give you enough time, just keep writing and I'll notice that you're writing, so I won't go. Methods of applying lower cost or net realizable value. You can apply it directly to each item in inventory. To each major category. Or to the total inventory. Okay, when inventory is written down to market, this is the new basis for inventory. under GAAP inventory that is written down cannot be written back up. Is that really a problem? So let's say you're selling catalytic converters and the company stops making the car that catalytic converter fits on. And so immediately you write down the inventory because you've got some left over that you're going to have to find another way to sell through part stores or something. And you write it down, but all of a sudden there's a big hit in the market price for all the precious metals in the catalytic converters. You guys hear the horror stories about catalytic converters, right? People come out and the car goes, and they're going, what's going on? They look under and somebody's stolen their catalytic converter. They're full of precious metals. And so if that price spiked, then all of a sudden you could go sell those, even though you're not selling a customer that you would usually sell to, you could sell them as scrap. Now, even though you've written that down, you wouldn't write it back up. What you would do is you'd recognize that additional dollars through revenue, right? Your sales would be higher than you expected. So in the end, it's going to adjust your cost of goods sold. But if you're doing the right thing, then that's not really a problem because it'll work itself out. Now, if you're purposely manipulating the financial statements just to try to increase your costs in one period so that you make more revenue in the next period, that's a problem. That's what's called in accounting world, in earnings management, taking a big bath. So you say, I'm not going to make my bonus this at the end of this year because it's been a bad year. So I go through all my accounts and I try to write off as much as possible. And so that means instead of missing my goal by like 1 cent, I miss maybe like 4 cents. But what happens is now in that next period, I've shifted a bunch of those costs. And if we didn't do it properly and with a good economic reason, then my profits will be higher in the future. And so even though you say, oh, it's a bad year, let's start talking about the future. And you can say, we're going to look better next year. It's not right unless you have an economic basis for it. And that's the type of things that auditors will look at. When you change something or do something different, they're always going to want to know why. But if you're consistent in your policies, then your financial statements will be consistent as well. If you are a business and you have these 3 options of applying it, you probably want to look at the total inventory. And why would you want to do that? Well, because if some products go down, then you're likely to have some products that just stay the same. And what happens is usually there's enough margin in there to reduce any kind of loss you might have. Plus, it's a super easy calculation. You just go, hey, this is my inventory. This is what I think I can get for it. I'm good. Now, your auditors may say to you, depending on how much of your product mix is in that old material, they may say you have to write it off because it's what's called material. Your investors want to know that you actually have some old inventory on the books and it's material to the financial statements. So auditors will say, hey, maybe it's too crazy to apply it to each item. Take care. Or you can apply it to each major category, but we're not going to let you go to the total inventory if it's material. So let's look at what they mean, and it's really straightforward here. If we're going to do this, we just look at the cost of the category, right? Or excuse me, the item. So if we're doing it for individual, we look at spinach and we say cost is 80, net realizable value is 120,000. And so we're just going with the lower of the cost, our net realizable value. And so here, 80,000. Spinach is the same, 100,000. Not a great margin, right? Oh, that was carrots, I'm sorry. Not a great margin. And then you have cut beans. and the net realizable value is 40,000. Now, if we go down to the canned vegetables, we have peas, $90,000 cost, $72,000 net realizable value. And then we have mixed veggies with a $92,000 net realizable value. So we would use these single categories and the value of our inventory would be $384,000. Okay, now we're just looking at major category. And what we would do is see, we have two categories. We have frozen and canned. And so for the frozen, we'd look and say, okay, our cost, 230,000, is lower than our net realizable value. And then for our net realizable value here for canned vegetables, 164,000 is lower. And so when we add this up, we get 394,000. And that's typically what you'll see when you start to use the major categories and the totals. You'll see that number climb back up towards where our cost is. And that's because there's more to offset it. And then the other thing you do is you look at it in total, in which case you just take the lower of those two, which is 415,000. So here, if we add another thing and say, how much would we have to write off? I think that's going to be 31,000. Here, 21,000. And here's 0. I'm going to check my math here. Okay, good. Pretty straightforward. Any questions? Okay, and take a second to read example 1. So in this first one, we're going to go ahead and put in what our cost is. And so we have 190, 106, and 53. All we're doing is taking that information from the